Hi there, Serial Trader here. Today I'm going to go through a little more than usual as I want to try and build an overall case for a potential risk-off environment that I think might be approaching here. And in the last few videos, I've certainly gone through my reasoning why I think we're nearing some sort of significant top here on the S&P 500. But what's really elusive here is the subdivisions of wave 5 of this overall 5-wave move that we're tracking here off the March 4th lows. Wave 1, 2, 3, and 4, I can certainly get my head around those easily enough, but just trying to get 5 waves within this wave 5, whether it be a diagonal or an impulse wave, I just can't offer a high confidence wave count at this point, but that doesn't mean that it's just going to keep going up forever. It just means right now there's a lot of ambiguity on the short-term price action, at least since our we'll call it the May 12th low here. But I still think we're pretty close to a peak here in wave 5, and just to offer let's say a measurement. So typically in a 5-wave impulsive sequence, usually only one of the impulse waves, whether it be 1, 3, or 5, usually only one of those is extended, and the other two, just as a guideline, tend toward being equal in length. Well, since wave 3 is definitely the longest move of this sequence, at least so far, unless we really just keep going here in wave 5, which I'm skeptical of. So we should currently, since wave 3 is longer than wave 1 by a good margin, we should do a wave 1 versus 5 equality measurement off of our wave 4 low here. And where would that bring us? That would bring us to 43.17.41. And right now, we've been as high as 42.86.12. So we're not far away from that equality measurement. We don't necessarily have to hit that equality measurement either. It's just kind of a guideline that 2 out of the 3 tend towards being equal in length, while 1 is extended. So that's just showing you that we're definitely close to what could be considered a finished sequence here. Of course, no real evidence here on SPX that we're done going up, but I think we're close, but no actual price action yet to the downside to suggest that. We got a gap here again, so at the very least, you should be expecting some sort of short-term pullback to that gap fairly soon, I would think. But that's not the main purpose of what I want to go through here. So we've gone through SPX. We know where we're kind of looking there. Let's kind of build the case. If this is going to be something more than just a minor top and correction, if it's going to be a full-blown risk-off move that's more significant, more substantial to the downside, there should be other ingredients lining up for that. So let's see if we can find them. Now, here is the Russell 2000 chart, and relatively clean. I don't have much labeled here. But what I do want to point out is a potential bearish wave count that so far is intact. And that's where the Russell actually peaked all the way back here in March, okay? And we had this initial impulse wave down for either a 1 or an A. We've since done this very deep retracement, but currently you can easily get ABC up for A, ABC down for B, and maybe 5 waves up for C of some sort of, now, can I actually consider this some sort of flat pattern? Because in a flat, you don't want the B wave to retrace at least, let's say 80% of that A wave. So let's put on that 0.8. Oh yeah, so we went beyond the 80% retracement, no problem. Did we do the 90%? Let me just check there, just so I can feel reasonable about this interpretation. 90%, let's try that. So yeah, in between the 80 and 90% retracement. So that's acceptable for a B wave of a flat. And then of course, we'd be working 5 waves up for wave C there of either 2 or B. Let me just get rid of that. But yeah, also the AC equality measurement, we've come just shy of that so far at 2350.7 here on the Russell. So bottom line is we also have a divergence. So even though now there's something called Dow Theory, but kind of a modern twist on that. We can also look at the Dow Theory stuff as well. But a modern twist on the Dow Theory is kind of the Russell and the S&P either confirming or not confirming one another's trend or price action. And it only really matters at turning points. Obviously, you can have, episodes of weakness relative weakness and relative strength as you're trending along, but at a certain inflection point, a divergence might be more significant. So let's just kind of dive into that. So even though we peaked in the Russell back here in March, obviously we've made new highs in the S&P, as of just, basically yesterday or very recently, right? So that's potential divergence where the small caps are not confirming the broader, or the larger, I should say, S&P index. And we also have a potential bearish wave count where we got that initial 1 down. We have 3 waves up so far to a lower high, even though it's extremely deep retracement. 3 waves up for either a 2 or a B. And then if this does hold, if we don't take out, this is the real line in the sand here on the Russell, 2360.16. That is the must-hold level for this potential bearish wave count to remain intact. And if it does, the suggestion would be either a C or 3 decline here, a substantial decline. So that's the Russell. So far, giving a bit of a warning sign, unless it gets invalidated at that level that I mentioned. What else did I want to go through there? Oh, yes. So then there's the Dow Jones Transportation Average. And you can see we're in quite a nice decline. Does not look like a very strong bounce off the lows here for the transportation index, and probably expecting more downside. So typically, once you've gotten into a trend, the transports typically lag, okay? Or sorry, I should say lead the trend, whether it be up or down. So right now I'd say, if we look at the Dow Jones Industrial Average, so the Dow Jones Industrial Average peaked on May 10th. The transports also peaked on May 10th. Now you can see the transports are certainly leading to the downside. The Dow obviously has had some downside, but more recently has a more significant bounce up. But nonetheless, and I won't put a wave count up here just to keep things relatively simple, but unless we get back above this level on the Dow Jones Industrial Average, which is 34,849, as long as we stay below that, this is technically just a lower high of a potentially still developing downtrend of lower lows and lower highs. Okay, so Dow technically in a downtrend right now, and being led by the Dow Jones Transportation Index. So that's kind of a risk-off bullet point to bring up. Let's just see. Yeah, I think I said what I wanted to say there about the Russell. Now, what else? So the only thing that's... let me just bring this up here. And let's go to the RSP. One thing I want to do before I go to the Nasdaq. So the RSP, let me just clean this up a bit, get rid of the volume, make it nice and clean. So this is the S&P 500, except it's equal weighted instead of being like the regular S&P 500 where the largest names have the largest impact on the index, being it market cap weighted. This is equal weighted, so it gives you a little bit of a different picture, kind of a peek under the hood. If you take the dominance away from the real big names, what does it actually look like? What's the index looking like? Well, it looks a little different. So we have potentially a divergence here between the equal weighted S&P. So yes, we've had a nice bounce up in the equal weighted as well, but we're not making new highs in the equal weighted, even though on the regular S&P, obviously, we just made new highs. So that's just kind of another divergence, potentially a risk-off warning sign that we're just having this final gasp up with the tech names, essentially, that has propelled the actual regular S&P to new highs, even though the equal weighted, yes, it's had a bounce, it has not actually gone up there and made new highs, and technically it's just going to make a lower high as long as it stays below this level right here, which is 152.53. So that's a data point to consider, kind of a risk-off warning as well. So let's see, we've done the Russell, we've done the equal weight S&P versus the regular S&P, we've done the Dow Jones Transports and the Dow Jones Industrial Average. This is what I want to go to next. So this is the U.S. 10-year Treasury yield, okay? So this is the interest rate on U.S. 10-year notes. And yes, we've had a pullback from our recent high there, which was as high as 1.77%. But it looks corrective, and it looks like we may be starting back up here. and I mean, I could throw a wave count on here, but just to keep it simple, I won't. Looks like we may have started back up here on the 10-year yield. And if that's the case, that'll probably correlate to putting some pressure on the big tech names. Well, let's go over to the Nasdaq 100. And obviously the real leader most recently has been tech. So let's the Nasdaq 100. Now this is basing off of the let's see here, off of the October low, we'll say. And this is the potential wave count to finish this sequence off the October low. And that's where you have this initial wave 1, then we have wave 2, then we have wave 3, then we have wave 4, then we have wave 5. Now this is a potential ending diagonal. And in a contracting ending diagonal, wave 1 is the longest. Then you have your wave 2. Then wave 3 is shorter than wave 1. And then you have wave 4. And again, wave 4 must overlap with wave 1, as opposed to an impulse wave where you cannot have overlap. And then wave 5, that must be shorter than wave 3. So it gets, each next leg up gets weaker or shorter in this ending diagonal sequence. Some people, traditional analysts, would call a rising wedge, although the criteria for ending diagonal is just a little more stringent. But let's keep with that. So I've already prepared this measurement. And if wave 5 was to exceed the length of wave 3, then this interpretation falls apart. But that doesn't happen until 14,832. Right now we're at 14,345. So this is the line in the sand for this ending diagonal interpretation to remain intact. And we're still comfortably below it. So that's on the Nasdaq 100. Possible ending. And also, you see it's quite typical to have this throw over of this upper trend line in your final move up. Just kind of that last panic buying before you reverse and come down. And we certainly appear to be having that nuance here on the Nasdaq 100. Now, for a while, there was a bit of a difference between the Nasdaq 100 and the Nasdaq Composite, but that difference has been erased. And now I think they're both in basically the exact same position. And that's, off the October lows, ending diagonal here on the Nasdaq Composite as well. And that's where you got the 1, 2, 3, 4, 5. And I've already prepared the measurement where 5 would exceed the length of wave 3 and invalidate this pattern. And that would be at 14,817 on the Nasdaq Composite. Currently, we've gone as high as 14,414. So still well below the invalidation level. And again, this currently can be viewed as a throw over, and kind of see we gapped up here, kind of that final gap up before you exhaust those panic buyers, okay, or those chasers, whatever you want to call them. So now everything is kind of lining up. We have a potential finishing sequence here on both the Nasdaq 100 and the Nasdaq Composite. And also, I just want to point out, just let me get rid of this. At a top, you would expect significant divergences on, say, RSI. Well, I think we got that. I pointed this out recently on the S&P, but let's look at the Nasdaq Composite. This is the weekly chart. Look at this. Lower highs on weekly RSI despite making higher highs in price. So that's a bearish divergence on that weekly RSI. On daily, there's one there as well, but I think it's more important here on the weekly chart. If you're proposing some sort of potential major finishing kind of top, you should have significant bearish divergence as one of your ingredients. Well, we certainly have that. And we have a pattern that we can certainly confidently label currently as an ending diagonal, and we have the exact level where that pattern or that interpretation falls apart, which we're still comfortably below. So let's just keep that in mind. Okay, so you can see how everything put together, maybe no one thing is that significant, but when you put it all together, the potential for an overall risk-off environment, and I don't mean a situation where, one sector goes down, but the other gets rotated into, and it's just kind of a choppy sideways overall action on the indices. No, risk-off environment where there's almost nowhere to hide, everything goes down, or almost everything goes down, small caps go down, tech goes down, financials go down, energy. I haven't looked at energy because it's a pretty small component of the overall market, but it's certainly looking very extended to the upside. It could roll over. Certainly, it's very overbought. Yeah, basically everything kind of goes risk off simultaneously. We have the preconditions for that to happen. It's not that useful when it already starts happening. Oh, look, it's risk off. Oh, look, we're crashing. To me, it's more useful to try and anticipate that with good evidence, not just because you're feeling bearish, but because there's actually signs on the chart and other data points you can look at that say, hey, I should be aware that this could be turning down here in a major way. I shouldn't just be chasing the last few drops of upside. Maybe I should be thinking about the other direction, right? So that's the purpose of this exercise here. I think I've made the points I wanted to make. I point out the potential finishing pattern here on the Nasdaq indices. I did that. Showed that we might be ticking back up here on the US 10-year rates, which would be bearish for tech based on its recent correlation. Definitely went through the Dow and the Dow transports, the message that may be sending. Went through the Russell versus the S&P, the message that may be sending. Went through the equal weight S&P versus the standard S&P, the message that may be sending. Okay, so I think we're done with that. Now let's go over to the thinkorswim candlestick chart, because I have some more things to look at. And before I get into the charts here, because there's not a whole lot as far as candles, at least on the S&P to look at. But what I want to go to is, what else do we got going on here? What else is happening underneath the surface of the market that we can point to that might be suggesting some risk off to come? Well, here is the E-mini S&P 500 futures. And look at the option statistics here from Friday. We only had 699 calls worth of volume. We had 4,774 puts worth of volume. I can't tell you how unusual it is to have so many more puts transacted than calls on what is normally a very lopsided call buying kind of market. High volume calls relative to lower volume puts on the futures. But okay, that's not very high volume. Obviously not that many people trade the futures options. So let's look at the actual cash index options. That gets a lot of attention and a lot of volume, particularly from institutions who move the market. Well, we had 516,865 calls worth of volume on Friday on SPX calls. We had 869,845 puts on SPX. So significantly more put activity than call activity. And again, what is normally a very call-dominated market, at least recently. So to me, that's a suggestion that there's some institutional bearish bets being placed here in a significant way. I mean, let's look at the option time and sales. So what can we point to here? Anything remarkable as far as a single order? I mean, okay, someone went and bought 6,100 puts at the 34.50 strike price expiring July 2nd of 2021. I mean, that's a pretty aggressive bearish bet. Could be part of a spread here or some other strategy, but still worth pointing out. Now let's go to what's probably the most important, because I think SPY has the most options activity traditionally of almost anything out there, retail and institutions alike. So let's look at the option statistics on SPY on Friday, the S&P 500 ETF, the biggest, most liquid one, right? So we had 1,549,351 calls as far as total volume, and 1,843,674 puts of total volume. So again, significantly more put activity than call activity in what is normally a very call-dominated market. To me, that's significant. With all the other things we're looking at, we're seeing where people are actually placing some bets here in the options market. Let's see if we can find any significant single orders that stand out here. Okay, we had some entity buy 7,300 put contracts at the 360 strike price, so like 3,600 or so on the S&P, expiring the 21st of January 2022. So that's pretty long term, so not an overly interesting thing. But nonetheless, just the general thing I'm trying to point out is put activity is picking up. We have all this kind of chart evidence building up of a potential risk-off environment on the horizon. There's some data points here we shouldn't be ignoring. Eventually the whole stonks only go up, money printer go burr, buy the dip. That works a lot, especially in a strong trend, but at a certain point it fails and you have some sort of downtrend or correction, and hardly anyone warns you ahead of time. They certainly, like to beat their chest as it's happening, or usually actually towards the end of it, they're starting to go bearish, and that's actually the time to be looking bullish usually. what I'm trying to do is point these things out ahead of time before it can really do some harm if you're positioned in the wrong fashion. Okay, so that's what I wanted to go through there on the options. I think made my point. Okay, SPX here, the daily chart. There's nothing remarkable about the daily candles here. Certainly no reversal signal yet. Weekly candles. What do we got? Anything to point out here? Weekly candle. Certainly no reversal signal there. So I got nothing to say of significance about that. Now the Dow Jones Industrial Average. Let's look at that. Well, we did have a gap up here on the Dow. So that's potential, gap up, kind of the last gasp of buying. Or it's a breakaway gap and we're just going to go, straight up and smash new highs. Currently, I'm doubtful of that, but let's see if this gap either holds or if we go down and close the gap and continue downwards. We'll see. But just to point out, there is a gap that, at some point will be closed. I'm thinking it'll be closed pretty soon. Not much else there on the daily candle, though, as far as a candlestick signal. The Dow weekly candle, I mean, it's basically just an inside bar of last week. So the high of last week's candle was 34,472. The high of this week's candle was 34,501. So we made a slightly higher high, but really just marginally. And we didn't quite make a new low. So it's largely an inside bar, with the exception of that little shadow there that poked and made a slightly higher high. Again, nothing really to point out as far as significant candlestick signals there. Nasdaq Composite. So the Nasdaq Composite, now is this... No, this isn't quite a bearish engulfing candlestick, but the Nasdaq 100 is, so let me get to that. So here we have a doji star, and then we failed to make a new high. So a doji star at this point in a range could certainly be a reversal candle. Not really confirmation on this candle on the composite. And on the weekly, probably not much to mention here. Just a big green weekly candle, so certainly no reversal there on the weekly. But again, a weekly reversal will come long after we see some shorter term reversals, right? Now let's go over that Nasdaq 100. So on the Nasdaq 100, we have something a little more bearish looking than the composite as far as the candlestick configuration. And that's where we have a doji, or you might even argue a gravestone doji, which is a potential bearish reversal at the upper end of a trading range like this. And then we have a legitimate bearish engulfing candlestick on Friday on the Nasdaq 100. So that's a potential reversal. Initial doji or gravestone doji, then a bearish engulfing, but we need some follow through. We need to actually start going down. But certainly a little warning sign there. And since tech has been kind of the culprit that's been propping up the overall market here, the S&P 500, a lot of the S&P's recent bounce was certainly tech fueled, as I pointed out there, with the equal weight S&P being much weaker and not making higher highs despite the overall index doing so. So if we do have a potential reversal here on tech, that's something worth noting, right? Weekly on the Nasdaq 100, I don't think there's much here on the weekly. No, nothing really to mention. But yeah, potential reversal there on the last 2 days here on the Nasdaq 100. VIX has made new lows, but not that unusual since the market's made new highs, right? But let's go over to that VIX tool, because there is something to look at again there. Always useful information. So again, we've been back on a buy signal, obviously. We got above the blue moving average on SPX, got below the red moving average on VIX. So now we're looking for the next signal, right? Well, so far, we're making a higher low on VIX, and this is a longer term divergence between VIX and VIX. So VIX making lower lows once again, but VIX so far making a higher low relative to VIX. So that's that potential divergence. Obviously, the next step would be VIX getting back above the red moving average, SPX getting back below the blue moving average. We're not there, but we have that first ingredient for the signal, at least for now, of that VIX divergence. So that's really all I wanted to point out, I think. Here's the thing. This is very difficult to do in real time, to top tick the market, call the top. And certainly even more difficult than calling is actually trying to trade that successfully. But what I've gone through today, I hope it just kind of paints the overall picture of where we could be heading here. Could there be a little bit more upside here in the near term? Sure, of course there could. But I think all the things I pointed out kind of culminating together, as multiple data points, we should really have our antenna up here for a potential reversal and some significant downside action. And I'd like to be ready for that instead of being caught blindsided like some people will and always will be, buying the top or aggressively trading long right at the top. You don't want to be doing that. So hopefully this has helped form that mindset, just looking at all that different stuff that I went through. All right, we'll see what happens this coming week. I'd love to see a reversal, but so far it remains elusive. Serial Trader signing off.